How you going, everyone? Nate here from Investing for Profits. Today we're going to be talking about the stock market and what lies ahead for the remainder of 2022. I'm going to give you a little bit of an insight into my portfolio and the cash and stock market ratio and how I've got to that point, and also what I'll be looking to do over the coming 12 months. I'll also give you an insight into what some of the ratios and metrics and things that I'm looking at in helping make those assessments so that you can get a better idea what you think you should be doing with your own investment strategy. With that, let's get into it. So I want to start out this video by making it really clear that what's going to happen in the stock market, we don't know. Nobody knows. We don't know when it's going to happen, what's going to happen, etc. But what we do know is that if you've got enough different measures and enough different ratios going in the same direction or telling you the same thing, there's an increased probability that your assumption is going to come true. In the same way that we go and we analyze or value a company, we'll have a look at that company to make a decision on whether we think we should buy it. If we go and look at one ratio, one metric, we're going to get a feel for that company, but there's going to be a lot more that we haven't investigated that could seriously change the value of that company in our analysis. What we're doing here with going and having a look at what's going to happen over the stock market over the next 12 months, the same thing applies. The more that you look at, the stronger your case or your story will build if all of the measures are telling you the same thing. So with that, there are no guarantees of what's going to happen in the stock market. All that we're looking at is a group of measures that come together that help increase the probability of us making an assessment that is going to come to fruition. So let's go and have a look at some of the ratios that I'm using to make a decision on the year ahead. I do want to make it really clear here that these ratios that I'm picking aren't ratios to sell a story or to sell a hype. This is an opinion piece. It's not a recommendation to go and do something. I'm sure there's many other ratios and metrics that might show the opposite. This is really just my opinion and view on the market and what that might be telling us about what's happening. If you've got a differing view, or even if you agree with what I'm saying and where the market's going, please leave a comment down below. I'd love to hear it. There's two sides to every coin, and that's again what makes the stock market so exciting. So anyway, let's go and have a look at what I'm looking at and why I think the market is heading in a particular direction over the next 12 to 24 months. So we'll have a look at four key ratios as part of this analysis. The first ratio is the Shiller PE ratio. The Shiller PE ratio is really looking at the price to earnings ratio based on an average inflation adjusted earnings for the previous 10 years. So what it's trying to do is remove inflation as a variable. So if we scroll down and have a look, we've got data here from 1880 or before 1880 through until current. This is essentially a PE ratio for the S&P 500 when factoring in inflation. What we can see is that if we set a PE ratio of 15 is a normal level, we could draw a line through here. Anything over would be overvalued, anything under would be undervalued. At the moment, we're sitting up around 35, 36, which is really, really high. In fact, there's only this one point that is higher than where we are today. So that alone should suggest that the S&P 500 is overvalued. But we should never look at just one ratio. We should always look at multiple ratios to make sure that we have a good understanding of what's happening and that we can validate our thoughts on what we think is happening in the market. So if we move forward and have a look at price to sales, we can see here, and this is going back to the early 2000s, that a price to sales ratio probably sits somewhere around 1.7, in between 1.5 and 2. At the moment, it's sitting up at 2.9. So without even knowing what price to sales is, but knowing that we're comparing the price of a stock against the sales that a company's making, we know that this is a really high number. What we're seeing now is much, much higher than what we've seen historically over the prior 20 years. So when we look at price to book value, going back to the early 2000s, we also can see that our current number of 4.46 is very, very high compared to where an average might be that probably sits somewhere around 3. We have been high before in the early 2000s, before we saw a big sell-off in the market, but we're sitting at a really high level now, which again suggests the price in which a company is trading for in comparison to its book value is really, really high. We then come to the Wilshire 5000 to GDP ratio. This is a ratio that over recent times has been made famous by Warren Buffett, and it's commonly defined as a measure of the total value of all publicly traded stocks in a country divided by that country's gross domestic product. Now, whilst we try and absorb that definition and understand what this is telling us, what we can see really quickly is that where we're sitting today is at a really, really high level. So even if you don't understand this definition intimately, what you will see is that we're trading at really, really high levels currently, much, much higher than what the mean average would be. Now, what is important to note here, even without completely understanding this ratio, if you're not clear on it, is from the 1970s, 80s and 90s, it's reporting a much lower number. On this chart, it's much, much lower. From the 2000s onward, it's much higher. If we take a look now at the PE ratio, the Shiller PE, we will see something that, in my mind, is quite similar. We can see a much lower group here that probably does sit around 15, but from the 2000s onward, maybe sits at 25, maybe even a little bit higher. Now, why is that happening? For me, this is part of the technological age that we've come into, automation, where it doesn't necessarily cost as much as it used to get the same outcomes. As a result of that, people are willing to pay more to get increased earnings. This is just my view, but I think it's really important when we're looking at data sets like this to compare like for like, or make sure that we're having a look at that long-term view, because I am a big believer in long-term patterns, but it's also important to make sure we're looking at that middle-term view as well as the short-term. So in that example here, when we look at this sort of middle term, if we take this pocket here from 2000 onwards, from a PE ratio, we're still quite high. However, we're probably not expecting to get back to 15. In my view, if we are getting back to 15, it'll be something that's a really big downturn in the market that drives it down towards 15, that it'll bounce back off pretty quickly. I think we're going to start to see levels that really start to shift and are more reflective to what we've seen throughout the 2000s. That being said, where we are today is still a really, really high level. If we roll back through these, what we can see is common trends that all of the metrics in which we're looking at, we can see that on today's values, the market seems to be running really, really hot. Does that mean it's going to continue? Absolutely it could. There's nothing that says the market has to come back. Based on longer term trends, will it come back? My view is yes. Will that be over the next week, month, 3 months, 6 months, 12 months? I have no idea. But for that reason, I think it's important to be aware of what's happening in the market and why you're making the investment decisions that you're making. So what does this mean for my investing strategy? Well, throughout 2021, I spent a lot of effort, not so much looking around at other opportunities, but looking at my own portfolio, having a look at the shares that I owned, of which I had 9 shares, and having a look what they were selling for in the open market and what I thought they were valued at. A lot of them, in fact, half of them I thought were significantly overvalued. And when I say significantly overvalued, I mean double the price of what I thought it was worth, it was selling for in the open market. So over a period of time, I started selling down my portfolio. I went from a position where I was sitting at approximately 75% in shares and 25% in cash to something now that resembles much closer to 50% in cash. I'm only currently holding 5 shares with all of the remainder sitting in cash. And that's really sitting there waiting to see what happens in the market. Why am I still holding 5? The 5 that I'm holding, I think, have really, really good value into the future. 4 of those 5 I think are currently overvalued, but when I start taking into account things like capital gains and all the rest of it, from my personal circumstance, these are shares that I want to be continuing to hold into the future and I think have significant upside from where they are today, even with the track record that we've been able to gain over the last 4 or 5 years. My view, very similar to that of someone like Warren Buffett, is that when you buy a share, the intent of buying it is that you're going to hold it forever. That's not always going to play out that way, but the longer that I can hold a share and allow that continue to compound, the greater my returns are going to be over the long term. That being said, if something is significantly overvalued and it pulls back and it drops 50% back to where I think it should be, it's going to take a long time to get those gains back to where it is today. Hence why I made the decision to sell them. So what does that mean for me over the next 12 months? I'm waiting to see what happened. At the start of 2022 or the very back end of 2021, I started talking to people about my views that 2023 was the year where the market was going to pull back. I'm not so sure now. There's a few signs in the market that maybe 2022 is going to be the year that it happens. It happened a couple of weeks ago. We saw a pullback in the market and I thought maybe this was the start of it, and the market has since steadied and has climbed back a little bit. But it could be that this is the year that it happens. Either way, waiting 3, 6, 12, 18 months sitting in cash isn't a problem. If that pullback happens and some of those ratios we looked at, if we see a pullback of somewhere between 25 to 50%, I don't know where it's going to land, and it may not even be that. But if that does happen, sitting with a pool of cash there, whether it's 20%, 30, 50, 80%, is going to give you a serious opportunity to buy into the market, and when you found a company you think is great value, have a really big swing at that company or multiple companies. So for me, I'm sitting in cash. I'm waiting to see what happens. I think there's a lot of uncertainty. My view is the market is seriously overvalued at the moment, and there's probably not a lot of upside. If the market doesn't crash, it's probably going to trade sideways for quite a period of time to come. So there's not going to be a lot lost sitting in cash. And I think for what will be gained being in the stock market at the moment, there's probably more risk in holding in the stock market, waiting to see what happens for a couple of % upside as compared to the potential risk downside. Again, these are my opinions only. They're not a recommendation on what you should be doing in the stock market or what you should be doing with your investing strategy. They're simply my views and opinions on the stock market as a whole. I hope that's been helpful for you. Please leave a like down below if it has. I'd love to hear any comments that you've got on this topic. It is something that can be very opinionated. Everyone has their own opinions and views, and that's important. That's what makes the stock market go round. So I'd love to hear your comments down below. And also, if you can please subscribe to the channel. If you find this content useful, please click the subscribe button. I'd really appreciate it. Until next time, thank you, enjoy, and happy trading.